Good morning, everyone, and thank you for joining us. My name is Ashley Brown, and on behalf of KLR and our affiliate companies, I wanted to welcome you to our 2023 year-end tax and business planning webinar. So as the year draws to a close, there's an urgency for business owners and individuals to navigate year-end tax planning. And today we will cover the status of the Tax Cuts and Jobs Act and its impending sunset, provide updates on the Inflation Reduction Act changes, and cover the latest on the ERC processing halt. We'll share some strategic business planning tactics for 2024 and beyond and answer all of your questions in our webinar today. Please join me in welcoming our seasoned KLR hosts, Laura and Anthony. Lori Alanis is a partner and director of our tax services group, and Anthony Mangiarelli is a partner and director of our enterprise solutions group. Just a few housekeeping items before I hand things off to Anthony. A link to a recording of today's webinar and a copy of the PowerPoint slides will be sent via email this afternoon. Also, webinar attendees will be the first to receive a link to download our 2023 year-end tax planning guides for both individuals and businesses. And with that, I will hand it over to Anthony.
Thank you, Ashley. Good morning, everyone. Thank you in advance for your time and attention. The leaves are falling. We ate turkey last week. Mariah's royalties will be kicking in soon, and the CBS holiday TV schedule for animated favorites is out. December 16th is Frosty and Frosty Returns. And speaking of Frosty, I'd like to introduce you to my remarkable partner who, when it comes to taxes, has ice in her veins. None other than Lori Alanis, who my ridiculousness every year still does not throw you off.
Good morning, Anthony.
Good morning. So today our agenda, we're going to cover, as Ashley said, the TCJA, as well as the Inflation Reduction Act, which kicked in this year. We'll go over quickly the Secure 2.0 Act. As we mentioned, September 14th was a pretty big day this year as the ERC credits were halted in terms of processing new claims. We'll go over beneficial ownership information, which I think is going to hit a lot of people by surprise. And then we'll go over some general tax planning suggestions, as well as looking forward to 2024 and beyond. So with that said, Laura, why don't you kick us off with the TCJA changes?
Okay, well, great. Well, as Anthony mentioned, we're looking at tax legislation, but for 2023, there really were no new tax acts that really have any impact for this year. What we're looking at is what prior year tax acts are doing to current year and to upcoming years. So the Tax Cuts and Jobs Act, we talk about this every year. There are some expiring provisions that will happen at the end of 2025. So I'm not going to spend a lot of time on them because we've still got 24 and all of 25 with the current rules, assuming no major changes with a new legislative body, if we do have a new legislative body at some point. But the things that will be expiring as of right now, expiring the end of 2025 for individuals, the marginal rates will return to the highest. We'll get that higher rate of 39.6. Right now, the highest rate is 37%. The standard deductions, which were largely increased once TCJA kicked in, almost double, those will go back to pre-TCJA levels, so it'll be about half the current deduction. Personal exemptions under TCJA, they weren't eliminated, but the amount assigned to a personal exemption was zero. So essentially they were eliminated, but those will return again. The child tax credit currently is at $2,000 max per child. That will be cut in half down to $1,000 per child. And then there was a new credit that got added under TCJA, and that was for other dependents, basically children age 17 and over, parents, if you're claiming them as a dependent, there is a up to $500 credit allowed on those types of dependents. That will be eliminated at the end of 2025, assuming no changes. In addition, everybody knows about the dreaded, hated $10,000 state and local tax deduction limit. That is set to be eliminated. Mortgage interest expense, We used to have a $1 million debt limit threshold plus $100,000 of home equity debt. That was eliminated under TCJA, but those levels will come back at the expiration of this act. Miscellaneous itemized deductions, those were eliminated under TCJA. They will be reinstated. Those are your investment interest expenses, not interest, sorry, investment expenses, unreimbursed business income, unreimbursed employee business deductions, a little tongue-tied this morning, sorry, and tax preparation fees, estate planning fees. Those are the types of miscellaneous itemized deductions that would be reinstated, still subject to the 2% AGI limit. And then overall limitation on itemized deductions, pre-TCJA, the amount that was allowable if your income was over a certain threshold, the total amount allowed would start to phase out. So that comes back under the expiration of TCJA as well. For business provisions, well, let's go back one slide. Under this, AMT was largely eliminated for most taxpayers under TCJA because there are two major add backs to TCJA that, or to AMT that impacted whether or not a person was subject to the AMT. One of those was state and local taxes, which under TCJA, it's only $10,000 now. Previous to that, we were seeing large add backs for state income taxes, real estate taxes. That was a large add back. Also, personal exemptions could be a significant add back depending on how many dependents you had. Those types of add backs will start to impact whether or not a person is subject to AMT after TCJA expires. In addition, the exemption amount of income subject to AMT was significantly increased under TCJA. It will go back down to the lower level. And the phase out under TCJA started at a much higher income threshold. Once this expires, it'll go back down to that lower income threshold. I see Anthony's face like there's some confusion there, or it's just, so the bringing back the state and local tax deduction to an unlimited number doesn't really get you as big a bang as you think for the dollar, because AMT will probably kick in.
Yeah, that's why I'm laughing, because I think a lot of people don't remember that they ended up in AMT because of it and ended up paying higher taxes.
Right. So it's a little bit of a smoke and mirror thing. You take something away and that's all people see, is that you're taking that away, but you don't see where the other benefit is. And it'll be the same thing. You bring it back and people will be happy that it's back, but behind closed doors, AMT is going to pick up again. So it's change. Is what it is. And then for business provisions, I think the biggest impact that especially small business owners are going to have with the expiration of this act will be the pass-through entity deduction, the code section 199A. That is the 20% business deduction that is allowed for pass-through entities, assuming certain requirements are met. Many businesses met the requirements. So there are a lot of businesses that benefit from this deduction, and basically it's 20% of the pass-through income is allowed as a deduction on the personal return of the business owners. This is for S corporations, LLCs, partnerships. That deduction is scheduled to expire. So that will be a big hit for small business owners if that does expire. Of course, all of these things could be any, all, some, none, could be extended if there is a broad agreement across both the House and Senate, which it's hard to get broad agreement with this current makeup of the legislative body. The other thing that is starting to happen now is bonus depreciation is starting to phase out. So we have enjoyed 100% bonus depreciation for many years now. And that is where you can take up to 100% write-off on fixed asset purchases. That in 2023 has dropped down to only 80%, and then each year it will drop another 20% until in 2027 we'll be down to no bonus depreciation. We'll still have the benefit of the Section 179 expense, which also allows for a direct write-off, but under that provision you do have to have actual taxable income in order to get the benefit of the deduction. Bonus depreciation is whether you have income or not, you get the full write-off. So, do you have any questions on that? Any thoughts about that, Anthony?
Oh, I think keep in mind with the bonus, Section 179 is still in existence, and that's the other program whereby you can automatically expense purchases in the current year, and that's pretty sizable amount. You know, I think it's a couple $1 million you can write off.
It's just over $1 million. I think it's 1,160,000 right now. So that is it is a very big benefit, but again, you have to have income to get the benefit of that. If you don't have income and you take it, it could carry over to the following year, but it may not be as big of, it's sometimes not as big of a benefit. But the other thing to keep in mind is that the 179 expense is allowable by most states, whereas bonus depreciation isn't allowed by many states. And so for states like Rhode Island, Massachusetts, Connecticut, there's an add back for that 100% bonus because they make you depreciate things over the regular 5, 7, 15-year time frame. So 179 is certainly a better benefit if you qualify for that benefit. So the other really big thing that we hear about all the time, and it is the estate and gift tax lifetime exemption. So going into 2024, that lifetime exemption is going to be $13,610,000 per person. So a married couple theoretically has 27,220, is my math right there, of 27 million of an exemption. After 2025, that is scheduled to drop down to 5 million, which was the pre-TCJA amount, and then it will be adjusted for inflation. We don't know exactly what that number is right now, but it probably will fall somewhere between 6 to 7 million with inflation. So that's a significant drop, and a lot of people have been waiting to see before they start doing some major gifting. But I think that time has come at this point where some major gifting decisions need to be made, because you can't, if you have a large enough estate, you can't decide a week before the deadline to say, I'm going to gift everything away. There's a lot of planning involved in making that happen. So there's a lot of discussions that are going to be happening over the next year, year and a half about strategies to take advantage of this lifetime exemption before that amount gets reduced. So that was it on TCJA. Again, we still have a couple of years before that does actually sunset, and it's anybody's guess as to whether or not any of the provisions will be extended. That's just, it really depends on what the appetite is for tax change and extensions at the time. So next up is the Inflation Reduction Act. That typically, the main focus on that act was green energy investment. And the biggest tax impact of that was really some tax credits around investing in green energy. So there are some expanded credits for home energy improvements. Typically the benefit will be up to 30% of home energy improvements that meet certain criteria. Solar, energy efficient appliances, new windows that meet certain parameters, insulation, things like that. You'll get up to a 30% credit. And if you have already used up your $500 lifetime from prior years, that doesn't matter now. It's this is a new expanded credit. So you may have an opportunity for some new credits up to 30%. Also, for vehicles, new and used clean energy vehicles now can qualify for a credit. However, there are some limitations that didn't exist to the prior credit. Now there are income threshold limitations, and the vehicle also has to ultimately be assembled in North America. So for new vehicles, you can get up to a $7,500 credit, and for the used vehicles, it can be up to $4,000. There's also a new credit put in place for qualified commercial clean vehicles, and that can be up to 30% of the cost with a maximum of $40,000. And the other thing is that some of these credits will now be transferable. So if you're buying a clean energy vehicle, you could transfer the credit amount to the dealer and treat it as a payment against your purchase price, which was nice because under the old rule, you had to wait until you filed your tax return and then get the benefit of the credit. But now you can transfer it to the dealer. Same thing with it. Some of these credits can also be actually sold on the market, on the open market. So there could be a market created for selling these credits, which could be a nice benefit for those that may not be able to use the credits. The other thing that part of paying for these credits was the restoration of the AMT for higher income C corporations. So this really won't impact many companies. It's just the very large corporations. And that tax will be 15% of the corporation's adjusted financial statement income. And for any corporation who has that income in excess of $1 billion. Anthony, do you want to touch upon what adjusted financial statement income might be? Because it's not taxable income.
I think the important part to remember in all this is the first time where tax code has come across the aisle and has gone to US GAAP earnings and US GAAP financial statements to say, hey, we're going to look at that as a mechanism to determine a taxable event. So that's the issue, is really now adjusted financial statement income is looking at US GAAP based financial statements to determine a taxable event.
Right. And I would believe that these are most of these will be audited financial statements. Somebody has income of $1 billion, it's likely a publicly traded company or a very large private company that has audit requirements. So I'm not sure that's going to impact many of our clients, but it is out there. Okay, so next up is the Secure 2.0, which is more focused on retirement planning and saving. And I think that's more your area, so I'm going to let you jump on that one, Anthony.
Sure. As I said, best in the business right there when it comes to taxes. But before we jump into Secure 2.0 taxes, I do want to just mention, Laura, you hit the nail on the head when you talked about the transferability of tax credits in the Inflation Reduction Act. And I think for large C corporations, we've seen an opportunity to go out and buy these credits working through brokers that we've worked with. And just to give you an idea, you can get a discount on these credits. So you could be paying 90 cents on the dollar. So if you've got $1 million tax, and this is federal tax now, if you've got $1 million tax, you can essentially buy these credits for 90 cents on the dollar and save some pretty substantial dollars for paying your income taxes. So if anybody has any questions on that, please reach out because we are working with different clients as well as brokers to make that happen. And it also segue into that the state tax credit market still exists as well, whereby if you owe a state, Rhode Island, Massachusetts, income taxes, there are some transferable credits you can purchase. Those are a little higher, probably call it 92, 93 cents on the market. We can also assist you with that as well. So keep that in mind as we talk about saving some dollars on taxes. And of course, you have to weigh it all with current interest rates if you're borrowing, because those are high right now. But jumping into the Secure Act, and as you mentioned, retirement kind of my arena. Before we actually get into the Secure Act, one other item that's not in the Secure Act but does deal with retirement plans is audits of retirement plans. And in past years, the assessment date was January 1st, and it was eligible employees. So if you had over 100 eligible employees on January 1st of a plan year, really 120 with some of the transition rules, but if you had over 120 eligible participants, you would need an audit for that year. The issue was eligible participants was comprised of those participants who had a balance in the plan, former employees with a balance in the plan, as well as current employees who were eligible to participate in the plan but didn't. And that could be a big number. You could have a lot of folks that were eligible but weren't actually participating in the plan and had account balances, but they still counted. So to get to that 120 number was pretty easy. Effective January 1st, 23, that rule's gone away in terms of if you are eligible to participate but don't actually participate in the plan, you are not part of the eligible participant count, which is good news for small businesses as you'll be under the audit threshold, and that could save you, $10,000, $15,000 a year in a 401k audit. Rolling into the Secure Act, the biggest thing I think is the first one is RMD age is increased to 73. And the way that works is by April 1st of the year after you turn 73, you have to take your first distribution. And then thereafter, you have to take your distribution by December 31st every year. So you do have the option in year one of delaying your first RMD until year two, but in year two, you end up with 2 distributions. Something to consider as we look at the TCJA and if tax rates are going to go up or down, because some of those RMDs can be pretty big. KLR Wealth can assist calculating what your RMD can be because it has to be across all your retirement plans. So something to consider looking at earlier than later. Simple IRAs and SEPs can now have Roth contributions. The penalty for failing to take an RMD drops. It was as high as 50%. It can be now as low as 10%.
And it's important to note that's of the balance of your IRA.
Very important.
So it's important to take your RMDs.
Another one that's in the act is that employers can now match contributions for employee student loan payments. So if you have employees that aren't participating in the plan because their student loan payments are so high, you cannot give them an employer match based upon them paying their student loans. This is an interesting one. The 529 plan is a plan whereby you can name a beneficiary and contribute funds that grow tax-free if they're used for college purposes. But you don't know when you fill out the beneficiary form and if you're going to have a child that goes to college. So some folks were reluctant to contribute. There's now a mechanism, and it does have limitations and restrictions, but there's a mechanism where unused funds in a 529 can now be rolled over to a Roth. And then this one, I think, is going to catch some higher earners by surprise in that 401 catch-up contributions now, if you earn over $145,000 in the prior year, your catch-up contributions now have to be made as Roth contributions. And there is some transition rules here. This should be taking place at some point. 2026 is really the year it's going to kick in.
And I think, Anthony, the key here is not just at the individual level, but there are a lot of employer plans out there that don't currently have a plan document that allows for Roth type contributions. So there are a lot of plans that have to be modified to make sure this provision gets added in. Correct?
Correct. So what I would tell you is if you've got a third-party administrator, it's probably important to start speaking with them now about amending your plan. If you've got a bundled plan, it may be important to speak with your provider about getting that plan amended. Part-time employees will now be eligible to participate in the 401k, 403b after 2 years of service. I go back to that comment we talked about earlier about employee benefit plan audits. Now we're getting folks without balances in the plan out of the count. they may creep back up if part-time employees who previously were not allowed to contribute to the plan decide to participate. So going back to, as we talked about earlier, you hear about one item, it does impact another item, so just be aware. Catch-up contributions for those folks over age 60 will be increasing $10,000 if you're participating in a 401k plan. And if you're in a simple plan, it'll be as high as $5,000. And staying on the theme of getting folks enrolled in retirement plans, there will now be a mandatory auto enrollment whereby most plans will have a 3% auto enrollment for any new employees, and every year that will increase 1% up till they have 10% being contributed to the plan. So again,
employees have to actually opt out of that if they do not want that to happen. So before it used to be they would have to elect in to participate, but now they have to know and be aware that this is happening. And if they don't want to be contributing, they have to opt out.
Yeah, and it's important to, as I said, get in front of this, because it comes down to messaging between HR, finance, and the employees, letting them know that this is in fact happening. So those are really the Secure 2.0 changes. So moving on to Groundhog Day. If you would have told me 4 years ago we would still be talking about the employee retention credit, I would have thought that you were crazy, but we are still talking about it. It is still one of the most highly sought after credits. Just a month ago, I did a credit for a company, worked with them, and they got about $750,000 that we filed the claim for. But if you go back to the KLR website, conwayton.com, you could see webinars we did back in 2020, 2021. We were saying the same thing. You've got to document your eligibility, make good business decisions, and remember that these claims will be looked at 2, 3, 4 years later. That holds true today, and we're seeing it now in real time as we've starting to see some audits happen. So, we went too quick, just to kind of tell you what's going on with the employee retention credit. We said last year on this webinar that the IRS was putting out warnings about being vigilant about claiming the credit. If you were using someone that was what they called an ERC mill, not a CPA or a tax advisor, to report it to them. And we knew that there was a lot of fraud happening. We saw folks waiting years and years to get these claims processed, these viable claims processed, because of the backlog, as the IRS had to filter through all these claims coming through. Now, to keep in mind, even though ERC was a CARES Act credit, if you're eligible for the ERC in 2020, you have until April 15, 24 to apply. And if you're eligible for ERC in 2021, you have until April 15th of 25 to apply. But what's going on with that right now is effective September 14th, 2023, the IRS announced a moratorium on processing any new ERC claims as they filtered through the backlog of claims they had. They also promised that any new claims would be scrutinized much more intensely than prior claims, as well as they'd be auditing claims that they have already paid, as well as claims in the future. Further, they announced that there would be a formal withdrawal process, whereby if you applied for the ERC and now have learned new information that maybe you weren't eligible, you could voluntarily withdraw your claim. And what that would do is it would prevent you from having to pay interest and penalties along with the credit back in the future if under audit you would deem not to be eligible. So I encourage everybody to please reach out if you haven't spoken to KLR about your employee retention credit claim, as some of the ridiculousness we've heard from some of the providers was just downright absurd. So just to remind everybody, ERC is available to businesses that met one of the following 2 criteria. Either you were experiencing a full or partial shutdown order during 2020 or 2021, that was a US government order that prevented you from doing business properly or impacted your business. That's really the gray area one. The second criteria was black and white. If you had a greater than 50% decline in gross receipts in Q2 or 3 of 2020 compared to the same quarter in 2019, or a greater than 20% drop in Q4 2020, Q1, 2, or 3 of 21 compared to the same quarter in 2019, you were eligible. And generally speaking, the difference to be eligible for the 2 years, 2019, you had to assess what your average full-time employee count was. If it was under 100, you were eligible in 2020 and 2021. If it was under 500, you were eligible in just 2021. And great credit if you were actually eligible. And I feel like we visit this once a year. It's these shutdown orders really were a gray area because, you know, it couldn't be voluntarily. The government, you know, asking for social distance, that was not a viable government order you could use. If you were dealing with factories overseas and they were shut down because of their government orders, that did not qualify. It had to be a U.S. government order shutting down you in the U.S. or limiting commerce in the U.S. You know, and then it was more than a nominal effect. What did that mean? Well, a greater than 10% threshold was considered by the IRS to have more than a nominal effect. And I think the example I used last year, which we saw a lot with the shutdown orders, were restaurants. Restaurants did well in the pandemic with takeout, but if you looked at their business in 2019, they did a lot of in-house dining, and I can guarantee that their in-house dining from 2019 to 2020 or 2020-21 was down greater than 10%. Therefore, they had a partial shutdown order. They were eligible for that. So those are the ones we saw locally that had the shutdown orders that were eligible. But as I said, it was really the Wild West out there the last couple of years. So the IRS has just shut down the ERC. Doesn't mean you can't file a claim right now. You can still file a claim. The IRS just will not review it or begin to process it till after January 1st, 2024. And then that withdrawal process that we spoke about, there's a formal process that's dictated on the IRS site. It depends on whether or not you've actually received a check already back, whether where your claim is. There's different parameters you can follow. If you are wondering if you should consider that, please reach out. We can help guide you through the decision tree there. But essentially, that's kind of unprecedented for the IRS to say, we're going to set up this voluntarily withdrawal process to tell us you are not eligible. You know, I think what I would tell folks is if you got some type of notice that's saying, hey, listen to the experts. If you had employees during the pandemic, you're eligible for $26,000 in government refunds per employees, and you jumped at it and you didn't get a binder back with support. If you just got this is what the credit is, here's the amount, one just gross amount, I would tell you to reach out because you really need to have support for what the actual credit is, your actual eligibility by employee. And it's getting really serious. Just last week, and you'll learn this acronym pretty quickly, the Department of the Treasury's Financial Crimes Enforcement Network, also known as FinCEN, you'll as we get through this seminar, you'll realize it's like the FBI, CIA, now this FinCEN. With the IRS Criminal Investigation Division, they have now to date identified 323 investigations that led to more than 2.8 billion of potential fraudulent claims. So this is why they have a processing halt, because they've identified billions of dollars of fraudulent claims, and now they're starting to ramp up investigations. So what does this mean? Going back to a slide we had just in our presentation last year for the ERC do's and don'ts, do create a workbook documenting eligibility and calculation of credit by quarter, by employee. Do include health insurance costs. Do aggregate all related parties. Don't be overly aggressive with shutdown orders. Don't claim owners' wages for ERC, and don't double dip with PPP. This was our last year's slide in our presentation. And I can tell you the audit letters have already started to come out. And while that's the audit letter, we're already knee deep in them. I'll give you a couple highlights of what the IRS is looking for. Essentially, they want a list of all employees who are paid wages for which the employee retention credit was claimed. They want the amount of wages by employee, the employee retention credit by employee that was claimed. They want to know if any related parties or owners are identified within that list of who you identified as receiving the employee retention credit. They want to know documentation showing how qualified health expenses was included in assessing the credit. They want a copy of the appropriate government order that makes you eligible for the claim. They want to know if you're part of a related aggregated group. They want copies of your PPP loans and how you applied for forgiveness. And the best part is, if you're on QuickBooks, if you're on Sage, the IRS will give you their instructions for sending your entire accounting package to them so that they can audit your gross receipts to see if you hit the drop. So it's pretty intense. As I said, we have represented several clients already through audits. I can tell you the biggest win we had was a client that did not use us to claim their ERC. When we got done with the audit, they actually got a check back from the IRS because it wasn't properly done. So I go back to something we said years ago. You need to have support in a binder showing how you got the credit, showing how you were eligible, and it's probably a good idea to revisit it. If you've changed payroll companies, even a better idea, make sure you have the files printed out because these credits will be audited for many years to come. You know, and speaking of Groundhog Day, PPP loans, remember them? I feel like I lived webinars back in 2020 where all we talked about was PPP loans, and then everybody got forgiveness and they went away. Well, guess what? In connection with all these compliance checks that are going on, the audit letters are starting to roll out. Just last week, we had 3 clients get them. Again, the documentation they're requesting all ties back to your eligibility, your calculation to how you determine the amount you are eligible for, as well as now they want to see how you obtain forgiveness. They want to see all your payroll records. Go back to if you didn't set up a due diligence file or folder, now's the time to make sure you know if somebody changed positions in your C-suite. As I said, if you change payroll providers, it's a good idea to spend a few minutes and make sure you have all the information that could be requested under audit in your files, because these notices can come out for several years to come still. And I'll kick it over to Laura for beneficial ownership because, as I said, she's the best in the business.
This is a fun one. So I think that we've been hearing about this for a while, but it hasn't really created a, it hasn't snowballed yet. And it is starting to now, as people are starting to really understand who this is going to impact and what it means. So this is a provision that was part of the Corporate Transparency Act, which was enacted in 2021. Most businesses will be impacted by this. The intent of the act is to help combat money laundering, financing of terrorism, and other illicit activity. I haven't quite figured out how this is going to do that, but that's the intent. It's a filing that must be done through FinCEN, and that's, again, Financial Crimes Enforcement Network, not the IRS, so it will be filed electronically through the FinCEN website. This is very similar to the foreign bank account reporting that also goes through the FinCEN website. This provision will apply to any corporation, LLC, or any similar entity that's created by filing a document with the Secretary of State or other similar office. So that includes single member LLCs. It includes partnerships, like family limited partnerships, anything that needs to be created under a Secretary of State or some other office like that. It also applies to foreign entities that got formed under laws of a foreign country, but is registered to do business in the US. basically what it is when the reporting is reporting who the beneficial owners are of the corporation, and they talk a little bit about what a beneficial owner is. I'll get into that. There are some exemptions to this reporting, and that includes publicly traded companies, banks and credit unions, securities brokers and dealers, public accounting firms, tax-exempt entities, and certain large operating entities. The reason for these types of exemptions, and there are a list of other exemptions as well. There's 23 exemptions in total, but these were the big ones that, you know, the other ones were a little nebulous and probably don't apply to most of the world. But all of these exemptions that are listed up here have other types of reporting requirements. So those other types of requirements apparently satisfy what FinCEN is looking for. So that is why these exemptions are included. The large operating entities is where many businesses may escape from this reporting requirement. And that is a company that employs more than 20 people in the US, has greater than $5 million in gross revenues and on prior year's returns. So it's a 3-year average on prior year returns, and is also physically present in the US. So if your company has more than 20 people and you average more than $5 million in gross revenues, phew, you don't have to deal with this. The reporting itself is not overly hard to deal with. It's just the method of it and when it needs to be filed. So we'll talk about that. For a beneficial owner is considered anyone who exercises substantial control or owns or controls at least 25% of the business. So perhaps there is a patriarch of a family who's gifted all of his interests to the kids, but he still has, maybe he maintained 1% interest in the company and that's the only voting share. He would be considered a beneficial owner. Things like that is what they're looking for. Somebody who actually controls the company, but may not actually be a 25% owner. When must this be filed? So this really goes into effect as of 1/1/2024. Any entity that is created after December 31st, 23 must file this reporting requirement within 30 days of creation. There is a proposed ruling out there to extend it to 90 days, but to my knowledge, that has not been approved yet, and I don't know if it will. So within 30 days of creating this entity, you must file through FinCEN, and you only have to do it once unless there's a change. So you file it once and you're done. If there's a change in ownership, a change in address, a change in name of an owner, maybe somebody got married, then you must file a new updated report within 30 days of that change. I can tell you what is making our accounting folks nervous is that our clients are really going to be looking to us to help them file these. However, a lot of times we don't find out about these changes until we're doing tax returns for clients. And it could be a year later, well after the 30 days of the change. That is one of the things that I know the AICPA is trying to get some changes pushed through on this, because some of these requirements they're just not reasonable. If you're an existing entity, if you exist prior to 2024, then you have until January 1st of 2025 to file. A lot of people are thinking, let's just push it off till closer to the end of the year to file it, because nobody wants to be the early adopters and have to deal with all the wrinkles that have to be ironed out early on. So many people are thinking they may wait until September or October and see what's happening. Maybe it gets repealed, who knows? I think that waiting game doesn't really work though, because as we've seen on a number of things, that waiting game has bit us in the butt a little bit in prior years. So again, if you're an existing entity, you must file this report by 1/1/25, but if you create a new entity, then it's within 30 days in 2024. The issue about this is the penalties for non-compliance. The penalties can be very steep, not just civil penalties, which can be $500 per day up to $10,000, but also criminal penalties. This is new, criminal penalties. You could serve up to 2 years of jail time if you don't comply with this requirement. It's crazy. Let's see, do I have anything else on this? That's what I have on the beneficial owner information. Really, it's a 1 to 2 page form. Again, it's not that, it has no tax impact how it gets reported. It doesn't change your taxable income. It's very similar to the foreign bank account reporting, where you're just reporting information and submitting it. But there are some steep penalties if you don't comply. Anthony, what are your thoughts on this?
I go back to everyone's going to know what FinCEN is now. I understand what they're trying to do, and they're using it under the coverage of terrorism and making it criminal. But essentially what they're trying to do is find out who owns the business, who controls the business, and who has the money. It's
right, and that the exclusion for the large entities. So basically, I see this impacting tradesmen that might have 5 to 15 employees. Those smaller businesses, I don't know how much they're laundering money, but
yeah. I think it's under the guise of that. They're trying to they couldn't hire their 87,000 new IRS agents, so they're going to try other ways to find out where things are.
Right. So, big brother, right? So we'll move along now to some tax planning strategies to consider. I think because there really hasn't been many new changes to the tax law this year, we're kind of looking at the tried and true standard year-end planning things where you try to push income out to the following year, try to accelerate your deductions into this year. Look at capital losses that might make sense to harvest before year end, especially if you have some capital gains that you'd like to offset. Some of the other things that we should be looking at for consideration, again, we talked about the potential sunset of the lifetime exemption for gifting. A lot of our business clients, the family's most valuable asset is the business. And so we're looking at succession planning for those types of businesses, gifting strategies, which could include potentially gifting shares of the company to the next generation at this point. And I know that some people are concerned about making those gifts now because they're not quite ready to give their wealth away, but there are ways that we have worked with clients to do that. And, Anthony, you and I have worked on a couple of clients, both together and apart, on some strategies there. Maybe you want to touch upon what we've been doing?
Sure. So, the biggest one, I think you mentioned this earlier with the beneficial ownership reporting. Folks may not be ready to give away control, but in order to use the larger exemption for estate purposes, you can give away wealth. And so what that means is you can take a company and you can bifurcate the stock rights into voting and non-voting. So essentially you can transfer a large chunk of ownership of the company to the next generation in the form of non-voting stock, but the patriarchs of the family can continue to own the voting shares. So they have essentially control. So you can give away 99% of the ownership of the company to the next generation, but keep 1%, and that 1% can be the only voting shares. So you retain control of the company. The one thing I would mention is that structure is key in all of this. And even though you've got, call it months now till this essentially potentially kicks in, go back to what you said with beneficial ownership. We've gotten bit in the behind before by waiting and thinking that items would be pushed out because of some of the dysfunction going on in Washington. So it's always better to be proactive and actually look at these strategies. You're going to need a valuation because the business is not necessarily liquid. And those valuations take time, and we go back to the bottleneck with ERC. There will be bottleneck with valuation firms as you get closer to the end of this year, trying to pump up these valuations. So if you want to talk about succession, now would be the time earlier in the year to start kicking off those conversations, because it does involve your estate planning attorney, as well as maybe the corporate attorney, as well as the CPA, as well as the family members that you're looking to gift to. The other thing I would tell you is if you're looking to possibly sell, you got to have that conversation too with the family members, because it may be in the best interest for you to sell the company, and you won't know that until you actually have the conversation about business succession.
Right. And that strategy you just talked about, where you can have voting and non-voting stock. I know some people are saying, well, I have an S corporation, and you can't have different classes of stock. The voting and non-voting classes are the one thing that S corporations allow a difference in shares. So it's a really great strategy to be looking at, and it is completely allowable. So just wanted to mention that. The other thing to consider as we're doing your year-end tax planning, as you are trying to project out your taxable income, is the R&D expenditures provision, this code section 174. This was one of the things that broad-based appeal to get rid of this provision, which essentially we've always been able to deduct R&D expenditures in prior years, but effective 1/1/22, the TCJA required that R&D expenditures would now have to be capitalized expenses and amortized over 5 years. If it was foreign R&D, amortized over 15 years. Both sides of the aisle agreed that this was bad for business. It was bad for investment in US businesses, but they could never get this repeal into a tax act that could pass. So we ended up getting stuck with it for 2022, and a lot of businesses ended up having a lot more income than they anticipated, because typically a lot of these, especially if it's a startup company, a lot of those companies, all they were doing was R&E work. And so they went from having a loss to actually having income, and that was a bit of a surprise. So remember, for this year, as you're doing your year-end planning, you've got to add those costs back. And in year one, it's a half-year convention. So even though you amortize it over 5 years, year one, you're only going to get a 10% deduction, because you only can treat it as if you had it for half the year. So year one, 10%, year 2, 3, 4, and 5, 20%, year 6, you get the last 10%. So that is something to keep in mind as you're doing your year-end planning. Also, if you are someone that thinks I don't have to do planning because I've got a net operating losses and current year losses, you are now still, TCJA limits NOLs to 80% of your taxable income. So there will still be some income if you have net operating losses. It's not going to wipe out 100% of your income. So again, plan for that. Interest expense, the 163J interest expense, this was a new thing as well under TCJA. And essentially, instead of being able to deduct 100% of your interest expense, that can be limited to 30% of your adjusted taxable income. Now, there is a small business exemption for this provision. If your 3-year average gross receipts prior to 2023 were less than 27 million, you likely this likely isn't applicable to you. But it also depends on whether there's some gray area on rental activities and whether or not that is considered a trade or business, or if it's a passive activity, does it mean that this expense limit is limited? So that is another provision to keep in mind as you're trying to project out your income. Again, we talked about harvesting capital losses, crypto scam losses. Anthony, I know that this is a pet peeve of yours and something you've been looking at. You want to talk about it?
You've probably heard FTX in the news, as well as some other losses. What I would say is this is a very complex area. There's different ways you can get tax benefits, capital loss or business theft loss, but also be aware that depending on the facts and circumstances, you may get zero tax benefit if you've been subject to a crypto scam loss. So what I would say is don't wait until you send in your tax data in the first quarter of next year. If you have crypto issues, have the conversation now, because based on facts and circumstances, there's different paths forward to how you may be able to get a benefit.
Right. Try to salvage something out of the loss.
Not get taxed on the appreciation for the crypto you lost is probably the best you're going to do in some cases.
Right. Future outlook. I mean, I feel like we really should just have a big question mark or magic 8 ball.
Reply hazy,
Check
try
again
again later. Reply hazy, try again later.
Right. It really just depends on who's controlling Congress and the White House. Right now, the Democrats control White House and Senate, and the Republicans have a slim control in the House. We just don't know what that will mean after the 2024.
What we do know is it means more compliance,
Right.
and more uncertainty, so that the best advice can be take a long-term approach to all your strategies.
Right. We just have a few minutes left. So we did have a couple of questions. Maybe we want to run down those questions quickly, and maybe it helps people. Personal tax strategies, we kind of just talked a little bit about that. Really, it's try to reduce your income as much as you can this year. Try to pull in as many expenses this year as you can. But I will tell you, don't go out and spend money just to save on taxes. If you're going to buy a new piece of equipment or buy a new vehicle, make sure you actually need it. It's something that you need. You don't want to go out and spend $50,000 on a piece of equipment that you don't need just to save maybe $20,000 in taxes, right? So be smart about that. High income wage earners, someone asked about backdoor Roth IRA contributions. Those are still allowable. And what this person is alluding to, high income wage earners aren't eligible to make direct contributions to Roth IRAs because their income levels are too high. And what it makes sense for some people to do is they would make a contribution to a traditional IRA and then immediately convert it to a Roth. This only works if you don't have any other traditional IRAs that have balances in them, because when you do convert that to a traditional, there could be a taxable event with that if you do have other traditional IRAs that have reduced basis in them. So this is something you'd want to talk to your financial advisor and your tax advisor on before you do, but it is still a very valid, very good tax benefit to take advantage of if you do meet those criteria. Bonus depreciation on vacation and secondary homes. So just to clarify, bonus depreciation is not something you elect to do. It is the default. You have to opt out of it to avoid bonus. So if you are taking depreciation on a vacation or a secondary home because there is rental activity happening, bonus depreciation does apply. You can opt out of it, but you still are only going to be limited in the deduction as to whatever percentage that vacation or secondary home is rented. So there are limitations based on usage on that. Anthony, you want to take the ESOP one?
Sure. Is ESOP a valid ownership structure for a professional services firm? Yes, it is. It's actually pretty ideal. We've worked with several clients over the years in the professional services field. As I said, ESOPs are expensive to set up, and there's a lot of compliance, but under the right circumstances, they can be ideal, especially in professional services, whether it's engineering, legal. We've seen it. You just have to be aware of certain, call it licensing issues in terms of who can be an owner of the firm. Legal always kind of trumps the tax and business side to it. So I would stress to check the legal requirements for ownership of the firm.
Yeah, I think it can be a very powerful vehicle for certain businesses, but it's got to be the right circumstance, because it's expensive to set up and maintain, because you have to do a valuation every year of the company, correct?
Valuation every year. more than likely the company needs to be audited because they have to report to the bank that's holding the note. And, you know, but it does give you the opportunity to get creative with phantom stock as well, because you are doing that valuation every year. But as I said, it's going to be the right circumstance, and always you have to look at the legal requirements for ownership.
Right. And then the last question here, any changes to the qualified business income deduction? That's the 199A deduction that we talked about earlier for the pass-through entities. That no changes in that, other than that it is part of the expiring provisions at the end of 2025. So that's all I have. Anthony, do you want to kind of wrap us up?
Sure. So please allow us to thank you for your time and attention as we wrap up another webinar, another year. We at KLR would like to thank our clients and referral sources for putting your trust and confidence in us. I've always said Laura and I are just two of the many faces of the firm. We have a remarkable team of client advisors, operations, and support staff to go along with our absolutely amazing marketing team. You met Ashley earlier. Ashley, along with our Director of Marketing, June Landry, the rest of the team do an absolutely phenomenal job connecting us to you. I direct everybody to our website that they oversee, conlitwin.com, where you will find all of our webinars, newsletters, blogs, volumes of useful information. It's all cataloged there. So please go to conlitwin.com. And we'd be remiss if we did not remind everyone that we are always looking to grow our team of advisors and our family of clients. So please, 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 when possible, be sure to pass on our name. And in the new year, we look forward to helping you grow your business and becoming future ready, which will be our initiative for 2024 internally. So best wishes for a happy, healthy holiday season and a absolutely remarkable 2024. And I will kick it over to Ashley.
Thank you, Laura and Anthony. I can't believe we're talking about PPP still as well. And thank you for closing things out. To be respectful of everyone's time, I just want to mention again that all webinar attendees will be the first to receive a link in our follow-up email to our 2023 year-end tax planning guides for both businesses and individuals. And you'll receive a link to a copy of the webinar and PowerPoint slides. So as always, please feel free to reach out to us if you have any questions. We're always here to help. And thanks again, and have a great day.
Thanks, everyone.
Thank you.